Hello friends. In this video, I want to touch upon a very critical topic for traders, especially day traders. I'm talking about the mental capital involved in day trading. You see, most of the times, traders tend to focus on the financial capital. But is trading a purely physical and financial game, or is it more than that? People like me who've been around for, I'm now 36 years into the market, I've come to realize that trading is a mind over matter exercise. It's a mental game. That's why I say traders are brain warriors. We fight, we win and lose with our ideas, not with our bodies, not with our computers, not with our keyboards and internet connections. And when the mind is fearful, when the mind is unsure, when the mind is not completely confident, it knows something is lacking. It will not let the body perform optimally, and you will therefore see trading losses. Now, in this video, I want to typically address why fear creeps into the mind and how to address each and every different aspect of why fear creeps in. Ironically, the traders that I talk to, the newbies who've just come into the market, are the least fearful because they've not experienced the bone crunching, morale busting aspect of continuous losses. So they come with a survivorship bias. In behavioral finance, survivorship bias is when you start any activity with the firm belief or at least very strong hope that you're going to succeed. Disappointment comes only later when you do not. So newbies typically tend to be the least fearful. Who are the guys who are more fearful? Now, the one thing that makes people fearful of trading is immediately after running into a string or maybe a single large loss in the previous trade. Now, this is completely natural. It's very normal, and if you're not fearful after losing money, I would say there's something wrong. Every time I lose a big amount of money in trading, I pull back for a couple of trading hours, maybe even for a day or two. I let the mind calm down. I let my hands become steady again and then get back into trading. Does it also apply for any trade that results in a big profit? Hey, exactly so. Even after making a huge profit, I think you should pull back for a while and let your mind calm down. Because after trading and making a big profit, you start to believe you're God. You can't do anything wrong. You know it all and you've cracked the code and you've hacked the market. That's when losses step in. Remember, the market knows where you're the most vulnerable, and that's exactly where it hits you. So don't be complacent. Learn to pull back both after big losses and after big profits. The number two reason why people and intraday traders especially feel fearful is because the subconscious mind knows it's not ready. You've not done your preparation, you've not checked out the charts, you've not done statistical analysis. If you're developing some kind of financial or statistical trading models, you've not done your homework and you've not analyzed the market. When the trading session starts in the morning, you're going in there completely unprepared, unsure, and cold. Your subconscious mind knows it's not ready. Believe me, the confidence that you have in each and every trade will be substantially lower. That's a time when you should not be trading. Either prepare like you're going to war, because trading is warfare. It's passive. Instead of guns and bullets, you're fighting with computers and keyboards. But losses are real. They deny your family most amount of essentials that they need because you lose money. So don't take trading very lightly. Prepare for it like you would prepare for a war. The third aspect why traders feel fearful is because they might be trading bigger lots than they can handle. This particularly happens in futures and options in the derivative space, because you don't get to decide how much you want to trade. The lot sizes are predetermined by the market regulator. What is the solution here? Maybe you should start trading in the spot segment, the cash segment, the delivery segment. And there you can trade with smaller lots and square up your trades intraday. And especially if they are short, you have no choice. You have to square up intraday. In a long trade, you might have the luxury of rolling over your trade to the next day. But then again, hey, that requires more money because you'll have to take delivery. Should you paper trade? Now, school of opinion is completely divided here. There are some who believe that paper trading cannot give you the kind of look and feel that real world trading will, because there are no emotions involved, there's no fear of loss, there's no joy of profit, and therefore it's not real. You might perform very, very well in paper trading, but comes to the real thing and you might just prove yourself to be a dud. That risk always remains. Better than paper trading is trading with very, very small lots in the spot segment. But if you can't even do that, then paper trade. At least you're doing something which is better than nothing. I favor trading with real money, maybe in the spot segment, if not in the F&O. Then, if you're not well capitalized, that means your trading account does not have enough money, your mind will be fearful. It's only legends on social media who say that you can start trading with 5,000, 2,000 and 3,000 rupees. Banish that thought. If you're going to make enough money to run your house purely from trading income alone, calculate how much money do you need to run your house. For example, if you're somebody living in the metropolitan cities with a family of 4, on an average, you should need anything between 80,000 to 1 lakh rupees, 100,000 rupees per month to run your house. How much return on capital would you need to generate 80 to 100,000 rupee profits? Be rational, be logical. Set your capital account rationally. When the mind knows that you're not backed with enough money in the bank, believe me, you will be trading very poorly, extremely poorly. And then your undercapitalized account will become a zero capitalized account in short order. The other reason why traders are fearful of trading is because they have come or resorted to trading because their other sources of income have recently taken a hit. You've lost your job. Your monthly checks have stopped coming from rental or whatever consulting or freelancing agreement, whatever you had. Let's call it risk-free returns. So your risk-free return checks have stopped coming and you're now coming to trading because you're forced to trade. Halt. I think if you've just lost your job, if your monthly checks have just stopped coming, don't rush in. Prepare. You know that old saying, if I had 1 hour to cut a tree, I would spend 45 minutes to sharpen my axe. Before jumping into trading for a living after you've lost your job, learn all that there is about trading before you dive in. That'll save you a lot of morale-breaking losses. It'll save you from a lot of sleepless nights, and it'll also save you a lot of money. The other reason why you could be fearful is if you're trading after a long gap. You've maybe gone for a holiday, you traveled abroad, or you're trading after a gap of a couple of years. I'll give you a personal example. After I got out of an exclusive contract with a publishing house, wherein I was, by requirement of compliance, not allowed to trade. When that contract ended, I returned back to trading, and I was restricted from trading only one segment of the market. So mercifully, my other asset classes trading was going on. But in the back of my mind, when I started trading the other asset class after a gap of a couple of quarters, I was a little unsure. But knowing what I do and having traded the market since 1986, I told myself, hey, there's nothing to be nervous about. Let's do a lot of preparation. Let's do a lot of simulation. Let's sharpen our statistical trading model and get back into trading. Sure enough, things had changed. The market texture had changed. Lot sizes had changed. The bid and offer sizes had changed. But the mind got around to it because fear will paralyze you. Rationality will set you free. So, being afraid of trading is no solution at all. And if there's a problem in trading, there are solutions as well. That's why behavioral technical analysis exists, because it is suited to the emotional behavior of a human being when it comes to taking financial decisions. It's a subdivision of behavioral finance. Welcome to our world of behavioral technical analysis, wherein we take a 360-degree worldview of financial markets. How would you like to have more videos on trading psychology, trading hacks, and how to succeed better at trading? Your feedback will determine how many more videos I will record in this series. I thank you for your patience in listening to me in this video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Have a very, very profitable day. And I love to hear from you in the comment segment, and share my videos with your family and friends and help me reach out to fellow like-minded smart investors and traders in your social media groups and WhatsApp groups. Bye-bye.